Hey, gang, let's get this show on the road. Let's get this party started. So, tonight we're going to talk about dividend stocks and really where we can put our money in this time of, what do we call it? A time where there is just very little that looks to be of value, right? I guess the way I'm looking at it is, and I'm stealing this phrase from Chuck Carnival, or I think that's how you say it, Carnival, or something like that, from FastGraphs. And his saying is that is a market of stocks, not a stock market. So we can measure the stock market, but overall, it's just a stock market. So we can look at the individual stocks. And tonight, I have 9 stocks that I believe are a buy, and so I may be throwing some money that direction. So I want to share those with you tonight. But before we do that, what I would like to do is share some news that I just saw. I don't know, it's been a couple of days ago, but I'm going to share this stuff with you because it is very interesting from my perspective. So this is Franklin Resources. Now, I used to own Franklin Resources. It's been about a year and a half, maybe 2 years ago. I liked them better at the time than T. Rowe Price, just because their yield was better. And then as I got to look more at the assets under management and the company's management itself, I got to the point where I didn't like Franklin as much as I liked T. Rowe. So I do still own T. Rowe Price, but I do not own Franklin Resources. But check this out, man. Franklin's bond leader put on leave as SEC investigation sparks stock sell-off. So evidently their stock dropped 12%. And this was, I think, 3 or 4 days ago, maybe Thursday of last week. And again, I'm just now seeing this because it's not one of my holdings, but I stumbled across it. And here's what the scary part is. I want to talk about this really more in general once we see what the specifics are. So it was disclosed that Ken Leach, co-chief investment officer at the firm's subsidiary Western Asset Management, had been put on leave, receiving a Wells notice. Now, so what's a Wells notice? This Wells notice signals that the agency may pursue civil charges against Kevin Leach related to cherry-picking trades for favored clients, and is part of broader investigations by the SEC and the U.S. Attorney's Office in New York. Now, that is pretty serious. I mean, if you're this guy, you've got to, you've got to have like diarrhea and stuff going on, because this is pretty serious for him personally. So Western manages about $381 billion of the firm's assets under management. That's a lot, because it's roughly 25% of their total investment base. That's a quarter of their business. He's on leave, and they're now under pressure to stabilize client confidence. Yeah, I think so. While the legal investigation unfolds. If regulators find that Western or its executive is engaged in improper trading practices, the outcome could result in heavy fines and settlements. However, at the moment, it is unclear how many clients were affected and to what extent the financial damage how far it could extend. The immediate concern could be that the reputational damage from the investigations could trigger further client outflows. So that's pretty significant. So what's the point of this? The point of this is, what we do as dividend investors is we do our DUE diligence. We do our due diligence. And part of that has to be the management team, because it is situations like this where there are executives making bad choices that can cost us as investors. Obviously the investors in Franklin Resources didn't play a part in this. It was a leader, and it may have been some of his cohorts as well. but taking part in this cherry picking scheme. So it doesn't give me a great feeling about Franklin Resources. I'm I'm not looking at it as a value play at this point. I think it is one to stay away from, but I think it's important for us. And so the lesson here, whether you own Franklin Resources or not, the lesson here is that we need to do our due diligence, and that due diligence includes researching as best we can the management team, how long they've been in place, how they make choices when things are bad. And so it's really a tough thing to do, but we have to do it. So what Simply Safe Dividends is doing is there's one other cool point here, is that if the firm loses this quarter of the business, it could cost them $80 billion. Let's see, how much is it? No, I'm sorry, $2 billion in fee revenue, or over 30% of its annual earnings. That's significant, guys. It would push their payout ratio to over 80%, which is obviously not good as a dividend growth investor. But so what is Simply Safe Dividends doing? They're saying until they have more information to better understand this legal development's impact on the firm's assets under management, we are reaffirming Franklin Resources' safe dividend safety score, with the dividend remaining covered even if Western loses a meaningful portion of its assets. I disagree with that. I think they need to pull that rating back to. I think they have a rating of safe, very safe, safe, and I don't remember what they are now. Then I know it goes down to unsafe and very unsafe, but like partially safe, I guess is the one. I don't remember what it's actually called, but I think they should pull that back until they know. So, anyway, the point is, it's important to do our due diligence, and even when we do the due diligence, sometimes things go wrong. So if we're expecting to bat 1,000% or 100%, batting 1,000 with our investments, then we're probably not going to be aggressive enough. We need to be able to get out there, make some investments, and sometimes we miss. And if we don't want to miss, then it's really hard to be a good investor. So, we don't want to miss. I think you get what I mean. We don't want to miss, but we can't avoid all investments because we're afraid of missing. So we've got to make the best investments we think we can at the time. Whew, there we go. Man, that was tough. That's a tough thing for Franklin Resources. So anyway, I thought I would share that with you. But so what we're going to kick off with tonight is I'm going to show you my top 9 buys. These are in capital letters. They're buys. I'm sitting on some cash, and so I am looking to get that invested. Now, when I say I'm sitting on some cash, the most I would ever have in cash in my portfolio is 10%. I've set that rule for myself. So I am always at least 90% invested in my portfolio. I am probably, say 5% in cash at the moment. So the other way to say that is 95% of the portfolio is invested. I do have 5%. It doesn't sound like much, but it's probably around 65 grand. So I've got 65 grand that's burning a hole in my pocket. So I want to do something with it. So I thought I would share those with you tonight. But before we get there, let's see who has joined us on the live stream. We've got Pat, and Pat has the first question. What do you do when everything you have is up? I'm just stacking cash. That sounds good. I think that's a very reasonable approach. I think it's also good to keep looking for particular bargains. You may not find the best deals. You may not find a deal like we had 6 months ago, but if it's a fair price, I don't think it's the wrong thing to do to invest in it. So let me get rid of that. There we go. Let's see. Kevin Mendoza is in the house. We do have two Kevins. I think we need one more for a quorum. So hopefully one of the other Kevins will show up. Shannon has joined us. Good to see you, my friend. He is from Atlanta, Georgia. We are only about 4 hours away, my friend. So if you ever get this direction, look me up. I will, I've got eggs. And oh, by the way, I needed to share this with you. This is fresh. And this is not a specimen bottle. This is honey. So I'm trying to get it without a glare, but this is honey from my bees. So they have been generous and they've given me some honey. And I will tell you, I've tasted it and it is really good. I don't know if it's because, I worked hard on it because, I mean, they did all the work, but I, bought the frames, got the bees, fed them, have checked on them and that kind of thing. But it is really good. It has got a wonderful taste to it. So Shannon, if you're in the area anytime, give me a buzz. I'll bring you a little jar of honey. How does that sound? So it's good stuff. So there we go. So got Chris, also known as Kamarai, in the house. Good to see you, my friend. Jim Betts is here. Good evening, fellow discerning investors. Absolutely. And that Franklin Resources is a great example of discernment. That's Jared. Hey, Jared. It's good to see you, buddy. Glad you're here. And Rust Moments is here. Oscar has joined us. El Dynamico. It is great to see you, my friend, from San Francisco. Brad Durfee has joined us. Good to see you, bud. Jim says he's never owned Franklin Resources, the stock, but did have a couple of Franklin Templeton funds early in my investing career. Yeah, they've been around for a while, and I think they at one point were very well managed, very well run. But boy, this is like a black eye for them. And as a fiduciary, and remember, I was a fiduciary for our company because I was chairman of the investment committee. So I had $14 billion that I was responsible for. And if I had, done any of that for my personal gain, then I would be in the same spot this guy is. So I was very careful about that. And the whole purpose was for the benefit of the participants. And so that's the way we kept it. So I was glad to have done that. Janice, good to see you, my friend. I saw you on Russ's stream last night, and that's good. Hopefully Russ will join us here in a little while. We have Greg. Greg is on. I think Greg's from San Francisco as well. Greg, let me know if I have that wrong. I know you're over that direction somewhere. Oh yeah, thanks, Jared. It's borderline safe. They have safe, then borderline safe, then unsafe. So Fast Eddie is in the house. Honeybee, hey Honeybee, I got some honey from my bees, so I thought you would appreciate that. And yes, homemade honey, and it's actually bee-made honey, so that's awesome. Let's see. Legendary is in the house, and that is self-proclaimed legendary. Robin, I haven't seen you in a while. It's good to see you. Oh, you're from Marietta, which is just north of Atlanta. Actually, my wife's uncle was in this weekend, and it was a very busy weekend for us. We celebrated a milestone birthday for my wife, and I will not tell you which one that is. And but anyway, her uncle, who lives in Marietta, actually came to visit for those festivities and that celebration. So it's great that you're from Marietta, and we got a connection there. Oh, Legendary is from Columbus, Georgia. So we've got some Georgia people. We got Georgia on my mind tonight. And don't make me sing, but we could sing that Georgia song. Georgia. All right, that's enough, right? All right, Slammer 6789. Don't calculate the hours you put into that little jar. Just enjoy the sweet taste. Yeah. So I had a conversation with a guy Friday morning. That conversation was something like this. As a beekeeper, you buy, you buy the hive, which has the boxes and the frames and the bottom board, the top board, the inner cover, and then you have, not only do you have one box, you've got at least three boxes, because you have two boxes as their brood chamber, one box is for honey, and then you go up from there, right? But each of those costs money. It's not free, right? Then you buy this yeah, this bee suit, you buy a smoker, you buy a hive tool, and you buy sugar so you can make sugar water to feed them when their resources are scarce. So if you can imagine, there is a lot of money that gets invested in a beehive. And that's just one beehive. Of course, the suit would go for all of them, but I have 4 actually, and I have the equipment to go up to 6 beehives. So each one of those is very expensive. So I told him, I said, hey, I got my first honey. I said, and that first jar is going to cost $1,000, but after that, I'm break even. So anyway, you are exactly right, Slammer. It is that first jar that is most expensive. And so I actually gave him the first jar on Sunday, and he said he was going to call Brinks to get armed security for that expensive bottle of honey. So anyway, it's kind of fun. All right, Robin sold out of Franklin Resources a year ago. That is great, and I'm glad to hear that, because I think it dropped 12%. It has come back a little bit based on what I saw earlier, but it's not looking good. Oh, El Dynamico, I messed up. You are West Sacramento. I think it is. Greg, not Greg. Who is it? Give me a sec. Yeah, I think it's Greg that's from San Francisco. So I got you guys mixed up. Sorry about that, my friend. All right, let's see. Yeah, Fast Eddie. It's cheaper to buy the honey than the bees and everything that goes with it. Yeah, exactly. That is true. And as a matter of fact, one guy said that the other day, who was also at that Breakfast Friday. He said, you can buy that honey, and for, I don't remember how much it was at the store. I was like, but it's just not nearly as much fun, and you don't learn as much. So life's about learning stuff. So. But anyway, it looks like we've got quite a few folks here. And if you are here, be thinking about, after I talk about my 9 buys, what I'd like to do is get some stocks from you guys, and then let's talk about those. And I've got these sound bites that if it's a great stock, you'll hear one sound bite. If it's a mediocre stock, another one. Or if it's a bad stock, you're going to hear a different soundbite. So, so if you've got a stock that you want to say, hey, is this good, mediocre, or bad? Throw it out there. We're going to look through those things, and I'm going to just make a call, and it'll be good, mediocre, or bad. So hopefully it'll be fun. I just want to have a little fun with that. So with that, let's get going. I'm going to stop sharing what I just shared, and then I am going to share with you guys my 9 stocks. Boom, there they are. And they are in order of what I believe their total annual return potential would be. Let me get my laptop positioned here. Okay, so you can see here that the top stock, at least in terms of annual return potential from my model, this is strictly my model. This is what I use. I'm just sharing it with you for your own fun and entertainment purposes only. Isn't that what PPC Ian says? It's for your own entertainment purposes. So anyway, here they are. The first one is Lamb Weston. I really still believe that there is value in Lamb Weston. I think it's going to be longer term than I had hoped, but I still think there's value in that. So it is a buy on my list. Second is Visa, and we've talked about that at length, so I'm not going to go into that. But I do believe Visa is also a buy at the moment. Thirdly, I've just added this to the buy list today, so this is fresh. It is like the ink is still wet on this one, and it is Google. I'm sorry, Alphabet, which is the ticker symbol Google. I don't own it at the moment. It is on my watch list, but I believe it's got a potential return of about 17% for the next year. And so I may be looking to add some Google. My fourth buy is Hess Midstream. We've talked about that at length, but I believe it is a buy at the moment. It has been going up, so we'll just have to see. But I do believe that it has a lot of growth ahead of it, and a lot of yield also. I mean, it's a 7%. Here, let me get my cursor in the right spot. It's a 7% yield, and what I believe will be a 9% growth each year. So I'm thinking it's going to be around a 16% total return. Then the next stock on the list, I think that's 1, 2, 3, 4. Number 5 is Microsoft. Now, I will share with you that I noticed that yesterday, the CEO of Microsoft, guess what he did? He sold a bunch of shares. I think it's $6 million worth of shares. So huge insider sell at Microsoft, $6 million worth of Microsoft stock. That's important to keep in mind, but we never really know why management sells. We always, though, know why they buy, and that is because they want to make money. They may have some boat payment, or maybe he's buying another house somewhere and needed the cash to do that. So who knows? But I thought I would point out that there is a big recent insider sell, an informative insider sell. If you don't know what that means, there's uninformative and informative. Uninformative means that they either got issued the shares or the shares were sold via a 10b5-1 plan, and they didn't actually say, I want to sell now or I want to buy now. Informative sell is, hey, I have these shares, I'm outside the blackout period, and I want to sell or buy these shares right now. That's an informative sell, and that's what this was for Microsoft. So it's important to point that out. My what is that? I should number these. 1, 2, 3, 4, 5. Number 6 on the list is Verizon, believe it or not. Now, I believe Verizon has the potential for 15% total return next year. And what's driving that is their yield is 6%. So, and what I'm targeting for my portfolio is an 8%. I think that's a conservative approach to grow the portfolio by 8%. Now, year to date, the portfolio is up over 13%. So I think I'm doing okay. But anyway, I believe that Verizon is undervalued, and I believe that its yield is in good shape. They don't grow their dividend much, so there's not a lot of growth there. But I do believe that there is some potential for Verizon moving forward. It is on my buy list. The second buy that is brand new today, hot off the press, ink is still wet, is Chevron. Now, I owned Chevron, and it went up into the stratosphere, and I sold all my shares. It's back into the 140s. I believe it's got the potential to be a good stock moving forward. So I am looking to add Chevron back to the portfolio at some point. I don't know if it's this week or next month or when, but it is on my buy list. It is number 1, 2, 3, 4, 5, 6, 7. Number 7. Number 7. Now, number 8 is U.S. Bancorp, and this is for those of you who know me, know this is not an unusual thing, because I've been talking about US Bank Corp for a long time. I it has run up quite a bit, but I still like that 4.4% yield. So if you're looking for a higher yielding stock that's still got potential for some growth, I think that is a good play. And then also United Parcel Service, UPS, is I think a good buy at the moment. So those are the buys that I have, and I want to share with you something else that I think you'll find interesting. At least I did. So in this model that I have, I determine what I believe the growth is going to be, and I believe I determine what I believe the yield is going to be, and I put those together and I look for the total return. And so if I have an account that's looking for higher yield, then I focus on higher yielding stocks. And if I am looking for growth, then I focus on the higher growth. But they are all, at least currently, they're all dividend paying stocks. However, what's interesting is there's also all these analysts out there who are predicting what the stock prices are going to be, what their growth is going to be. So I'm now able to download that information from some of the apps that I subscribe to and compare what the analysts are saying the growth will be for those stocks to what my model is saying. And so here's a comparison of these buys. Let me find a way to move this over. Okay, here we go. So we have the model growth for Lamb Weston. My model says it's going to grow by about 23%. That's not total return. That's just the share price appreciation. Now, analysts are saying it's 14%, but I'm okay with that, because what if it only grows 14%? So I get 14% plus a 2% dividend. I'm still 16% ahead in 1 year. So I'm good with Lamb Weston. And what's really interesting is that my model and the analysts on Visa are exactly the same, 16% for both. So I think that's pretty good. My model says 16% growth for Alphabet, but the analysts are saying 23%. So, my model's a little more conservative there, but I'm good with that too. I think that's a good approach. I think Hess Midstream is going to grow at 8%. Analysts are saying 7%, so that's not too bad. So all that kind of lines up. Microsoft, I'm saying 15%. The analysts are saying 22%. Verizon, I'm saying 9%. They're saying 7%. All of that kind of lines up. We come down to Chevron. My model says 11%, but the analysts are saying 20. So, I'm from a conservative perspective, I think my model is working there. Then we come to US Bank Corp. I think it's at 6%. The analysts are saying 8%, so that's pretty well in line. But we have United Parcel Service. I think it's going to grow by 5%. They think it's going to grow by 12%. So I think all of this lines up. So, my model, the analysts are all lining up. All the stars and the moons are lining up. And so therefore, I believe these are solid buys right now for my portfolio. Wanted to share that with you guys. But here's one question I have for you. And let me do this. Let me get rid of the, what do I want to get rid of? I'm going to go to, somehow I have this limited, but I'm not seeing it. Must be here. Yeah, it's here. Okay, I'm going to put every stock. So this thing now is tracking 57 different tickers. And it's really kind of cool the way it kind of holds together. So anyway, that's I think it's cool anyway. You guys probably may not, but so what I wanted to share with you is this. Here's the question. ASML, which is, I believe it's in the Netherlands, I think, and it is the company that makes the equipment that makes the chips. So it's the company that makes the machines that are either sold to Intel or the one in Taiwan Semiconductor Manufacturing. So these are this company ASML makes the machines that these chip manufacturers are buying to make the chips that they need for their chip manufacturing. So highly technical, very wide moat, because not everybody can make this level of technology in the manufacturing arena. So it's obviously a good stock to look at. My model says there's only going to be 8% growth. However, the analysts are saying 37% growth. So I ask you guys, what do you think about that? I mean, is there something that is going to be so much different in the future that would cause this stock to have growth of 37% versus 8%? I need to dig into this myself, but I wanted to see what you guys thought about that. So, and then there's this goes the other way, but I kind of get this. I understand this. This is an ETF, so my model's not going to calculate much of a growth for an ETF, but the analysts are saying it's going to grow about 23%. So obviously, I'm not selling. It says sell here, but I'm not selling it. It is something that I have. It's about 2.93% of the portfolio. I do plan to hold it, but the model says to sell, but the analysts are saying, hey, there's going to be a 23% gain. So we will just have to see. But the one I wanted to really ask you guys about is ASML. What do you think? Are the analysts right? Or, is the model missing something? Or do you think the model is more correct? Let me hear from what you guys are thinking about that. All right, so let's get out of this and let's get to you guys. I want to hear what's going on in your portfolios. What did you buy? What are you selling? What do you want to look at? And let's go from there. Let's see. All right, Greg has shared that he is from Huntington Beach, California. So I was wrong on both accounts, but he is Southern California, so that's good. Okay, Janice says QQQM. I think that is a ETF, right? Let me do a quick search here. Yes, that is the NASDAQ 100. So I'm going to pass on that one because it's a ETF of a conglomerate of different stocks. So it'll be hard for me to make a call on that, because it's really about the market. Where's the market going to go? Are we going to have a soft landing? Are we going to, what's going to happen there? So I'm going to pass on that one, if you don't mind, Janice. We'll just hit individual stocks here. Did I steal Kramer's soundboard? No, I wish, man. He has got some cool sounds. Mine are cheap. So actually, they're so cheap, they're free. So here we go. Let's see. Why are people buying DTE? That'd be Detroit Edison and Misty, or who is XDTE? Maybe I should look this up. DTE is Detroit Edison. Is there an XDTE? Yes, there is. Round Hill S&P 500 covered call strategy ETF. Yeah, no, I'm not wild about those. And MSTY, let me see what that is really quick. Now I am, let's see. Oh yeah, the yield max stuff, option income strategy. Yeah, I'm not wild about either of those. So let's talk a little bit briefly. And do you like my hat? My hat came from Yellowstone, and it's the only time I can wear it is on this video, because it is all leather. There is no, the only breathing it has is these two little holes right here on the side, on each side. So it is so hot. I think it's going to be 100 degrees tomorrow here and Wednesday. And it is just way too hot to wear this hat. So you guys get to see me in this hat, because that is the only time I really can wear it with any purpose anyway. But anyway, moving on, back at the ranch, the covered call ETFs, why don't I like them? Why I don't like the covered call strategy, even if it's within my portfolio, is that what I'm doing by buying covered calls is I am giving someone else the option to take any gain above the strike price. So I am basically giving away large upward movement in my stock price, and I am bearing the risk of loss of those stocks. So if I'm giving someone the right to buy the stock at a certain price, let's say it goes up, then if it doesn't hit that price, they don't have to buy it. If it goes down 20%, I bear that loss. So I'm bearing the loss. They get the large upside, and all I get is a little sliver of premium. So I mean, there's applications for it, but from a portfolio perspective, to me, it doesn't make a lot of sense. Um, so, I'll leave it at that. And there's people that disagree with me on that, and that's okay. I don't care. You can disagree with me if you want. But, it's just the way I feel about it. The option income strategy, again, it is focused on income. It is not focused on total return. You can get a huge dividend yield and the stock price continue to drop each and every quarter, each and every year. So therefore you're getting the cash back, but you're really getting your own investment money back. It's not income if the stock price goes down. So don't like either of those. Why are they buying them? I'm not really sure, Kevin. I don't get it. They are risky investments. I don't look at it as investing. I look at it as income generation. Maybe that might be. And if somebody's looking for income and they're using it to develop income, and they've got current expenses they got to deal with, I would get that. But any outside of that, if you're trying to grow a portfolio, I don't think either one of those is a good approach. So was I unclear? I'm not wild about those investments. AbbVie, Pat wants to know about AbbVie. So let's take a look. So this will be our first shot here. Let's do this. I'm going to share this screen with you guys so that you can see what I'm seeing. How's that? All right, let's look at AbbVie. We're going to start. Let's do this. Let's go out of order this time. We're going to start with Morningstar. Now, Morningstar changed their site up a little bit, and it just causes me to pause because I don't know where to click anymore. But it's probably better. It's probably a better layout. I just have to get used to it. Okay, so AbbVie is currently, wow, 197. It has really been doing well. Let's see what the last, that's not going to give me that option in the screen, but their fair value is 176. The current price is 197. So according to Morningstar, AbbVie is overvalued. So, you'd want to be careful about that. Let's take a look from Simply Safe Dividends. AbbVie is a safe dividend at 80. Its current yield is 3.14%. In all fairness, just to full disclosure, I used to own AbbVie and sold it. Now I wish I hadn't. Now that I see it's almost $200 a share, but I sold it somewhere around 160. Bought it around 105, I think 110, and I sold it around 160. So I think that went okay. It was a yield stock for me. So what I did was once it got to a low enough dividend yield, I went ahead and sold it and reinvested into higher dividend yields. So I think it turned out okay for me. Let's see, 80. Let's take a look at their dividend growth. Their last 5 years is 9%. The latest was 4.7. You can see that they were a spinoff, I think, of Abbott Labs in 2012. Yeah, here it is. Abbott Labs, 2012. So they get credit for all of the previous years of Abbott Labs from a dividend perspective. So that gives them 52 years of growth and 100 years of dividends. So, but in reality, it's more like 12, just when as a standalone company. It's about 12 years. Let's take a look here. Their dividend is growing. I think that's good. Look at their dividend yield. So over the 5-year history, their average dividend yield was 4.31%. It is now 3.14. Their PE ratio is around 17. Their 5-year average is around 10. Now, we know why that is. We know it's because of Humira and the uncertainty around, them losing the patent for that drug. And so there's a lot of uncertainty a couple of years ago. And that's why I bought into it. It's because I didn't believe all of that. But the point is that it is still a yield below the 5-year average and a PE above the 5-year average. And Morningstar says it's overvalued. So all of these things are pointing to that it is probably overvalued. Their earnings payout ratio is around 50%. So that's not terrible. Look at their earnings per share, though. It's flattening out. That's not a good sign. Their shares outstanding, they have actually, they've grown their shares outstanding over the last 10 years, but it's been pretty flat the last, let's say, 4 years. Sales are flattening out, which would be expected with that drug coming off of patent. Return on invested capital is around, 22%, which is not bad at all. Interest coverage is about 7, so they've got some debt there that they need to figure out how to deal with. So net debt to capital is 89%. That's pretty high. So high debt, nice return on invested capital. So let's is there anything else we need to look at? I think let's just, for grins, take a look at FastGraphs real quick, just because it's fun. And we can see that according to FastGraphs, they are, again, overvalued. They're saying it's 18.04 PE ratio. And they are, overvalued according to FastGraphs as well. So here's what I would say about FastGraphs. And I'm going to say that it is mediocre. Now, why do I say it's mediocre? I'm going to say that's mediocre. Just a little clap. So I'm going to say it's mediocre. And it's because I think it's overvalued, because there's this uncertainty, maybe, with Humira. But I know there's some other drugs. Is it Skyrizi, or maybe I've gotten those confused, that are coming on. But I think I wouldn't want to pay $200 for AbbVie. I think that is too high. So I'm going to say they're doing some good things. Their debt's too high. But I'm not excited about it. So there you go. How's that? All right. Let's see here. Siri. What is Siri? Yeah, my phone's going to start talking here now. She's like, Sirius. There we go. Sirius Holdings. Yeah, it looks to be undervalued here. Let's see what Morningstar says. I'll go through these a lot faster now. Sirius, fair value. Ooh, $5 is a fair value. Price is $3, so it's significantly undervalued. About 40% undervalued. Let's take a look at Simply Safe. Borderline safe at 50. That's not, not alarming. See what some of the... All right, so they've been growing at a very fast pace, 17% over the last 5 years. Latest was about 10%. That's pretty fast. Their yield is very high, and their payout ratio, or their PE ratio, is very low. Earnings payout ratio is pretty decent. Let's see. this is actually looking more attractive than I thought. Shares outstanding have been going down. Sales have been going up. Return on invested capital, 26%. That's pretty nice. Net debt to capital, looks like they have no net debt. Interest coverage, though, is only 4.93, which is not good. I don't understand why they're not showing up with any net debt. I mean, I would need to look at their financials, I guess. And I won't take the time to do that, but there's a lot to like here. The only thing that I don't like, Fast Eddie, is it's kind of considered a penny stock because it's $5. Well, it's actually trading in the $3 range. So that, in my mind, that's considered a penny stock. You know, it could go under very fast. So yeah, I don't know. But I do like a lot about it. I love their return on invested capital. I love their payout ratio. I like their dividend growth. So there's a lot to like there. But I will tell you, I think for this one, I'm also going to give it mediocre. The mediocre is because of that level. It's not making enough money to cover the interest, at least at the rate that we would want. So if they get that fixed, they might be somebody that I'm interested in. So hey, great question. Let's see what's next here. Oh, good. El Dynamico pulls the trigger on some CVX today, some Chevron. That is a good move. MPW, I really don't even need to look them up. I looked at them as an investment, and I will just say, no, don't go there. Don't go to MPW. That is a dumpster fire waiting to happen. So sorry about that, Lou, if that hurts anything. But it's just too much. There's just too much going on there. So I would say no on that one. Let's see. What do you think about DDS Dillard's? They have a 3% payout ratio, 3% and 9 PE. Yeah, I'm usually not that excited about retailers, but let's take a look. They have unrated dividend safety. They've got a dividend yield of 0.28. Wow, looks like they've been paying a dividend for a long time. It's weird that their yield is only 0.28, but yet they grow it by 18% per year over the last 5 years, 9% per year over the last 20 years. So what's the deal with that? Earnings payout ratio is, wow, it's really low. Earnings per share, I'm not sure what happened in 22, but Dillard's was like making $3 a share, and then all of a sudden they went to $40 a share. But that is they're taking care of that. It's now down to 29. Just give them a few years; it'll be back to $3. Shares outstanding are moving down significantly, so that's not bad. Let's see what the debt's doing. Wow, their return on invested capital is huge. They must have done something. Their margins went way up, so they must have started selling something that's very profitable. Man, that's a nice return on invested capital. Their interest coverage is fine. Wow, other than my complete dislike for retail stores, I don't know. I may just based on what I know. I mean, there may be some other news here that I'm just not aware of. I don't follow Dillard's at all, so let's see. What am I going to do? What am I going to do? Got to make a decision. I think it's. I think. Oh, let's look at one more thing. Let's look at DDS here. I want to look at their chart. Let's look at year to date. They're down 13% on the last year. They're up 8%. Pretty volatile. Let's look at the longer term view. Yeah, they've got some volatility. Let's see what the analysts are saying. There is no data, it looks like. There are no analysts that follow them. There is one analyst that's not a top analyst. There are four. Actually, there's four. Two holds, two sells. They're saying that there's a 2.85% downside. I tell you what, I think for me, this is going to be a mediocre. I think it's a mediocre. But I'll tell you, I thought it was going to be a bad. So the fact it's mediocre, I think is, I think it's a good thing. So I mean, it's certainly worth looking at. Let's flip back up to here. All right. Chris says he loves the Visa, Microsoft, and Google. Three of my biggest positions. That's awesome. I think yeah, I think I'm gonna head that direction in some of my other buys. Lewis says he says I own them all except French fries stock. Yes, absolutely. So French fries is not for everybody. I mean, if you want to be gluten free and you want to go on a low carb diet, French fries is not for you. So that's good stuff, man. Jim says he's got Visa, Google, Microsoft, and in his growth portfolio, and then Verizon and USB in his dividend portfolio. It's very similar to me. I don't have Google, but I do have Visa and Microsoft, and I have both Verizon and USB. So my buddy Russ has shown up. Good to see you, buddy. Late to the show, but did you mention that Franklin's CEO, Jennifer Johnson, just bought 18,900 shares at 20.95 on Friday? She now has 5.864680 total shares. I did not mention that because I didn't even look that up. So that is, I mean, if you're a CEO and you've got some stuff going on, might be a good way to try to get investors to not panic, right? So that, I don't know if that she's buying it because she knows enough to know that there's not anything there, or if she's buying it because she wants to ease investors' fears, or both. I'm not really sure. So, but that's a good point. I'm glad you brought that out. Let's see. Fascinated. Do you think he was taking some profit? Yes, absolutely. Yeah, and I think you're talking about the Microsoft CEO. I forget his name off the top of my head, but he just sold $6 million worth of stock, and so yes, he was absolutely taking some profit. It is what's interesting is that was an informative sell of an uninformative buy. And what that means is he probably got those shares as part of his compensation package. So, him selling those may or may not mean anything, right? But it's a lot of money. It's $6 million. Yeah, it does look like a specimen bottle, Russ. It absolutely does. Here, let me get this off the screen. Looks like a specimen bottle, but it is not. It is honey. Maybe you can see how slowly it oozes there. It is very thick and gooey, sticky deliciousness. It is really good stuff. Okay, let's see here. Walmart insiders sold a bunch of stock last week as well. Yeah, I don't blame them for that. I mean, the stock's been going up, and sometimes you got to take the profits when you can. So, it sounds like, at least what I've been reading about Walmart. Again, I'm not a huge fan of the retailers, but Walmart, based on their last earnings call, is really not in bad shape. I mean, they've got a really good online business going. It is growing. And so there could be a lot of potential there for Walmart. And I think investors are seeing that, and they're buying Walmart stock. I'm not buying Walmart stock, but some are. So let's see here. Let's see. Yeah, Chris says he doesn't like the forward payout ratio for UPS, Let's just take a look and see what that is, just for everybody's enjoyment. Let's go to Simply Safe Dividends, type in UPS. So again, it's a 5% yield, so it's a pretty high yielding stock. I wouldn't expect a lot of growth. You can see their growth is 0.6% in January. So high yield usually equals low growth. Not true in the case of Hess Midstream, but most cases it is. It's a safe dividend rating at 69. So the stock issue was, let's take a look there. Earnings payout ratio. Yeah, it is growing. And the last 12 months it was at 90%. So it's a bit scary. And my thesis is that management's going to get that figured out. They have lost some business to the United States Postal Service, and also Amazon is creating their own distribution hub. So we'll have to see. I don't know if they will or not, but my thesis is that they are going to figure that out, that they're not going to let that continue to erode. And you can see the next 12 months, it goes from 90 back to 79. So they're going to be making the right moves. And again, I'm a long-term investor, so I'm not looking at tomorrow. I'm really looking for 5 years from now. And I think UPS might figure this out. But yeah, I get it. I'm with you, man. I don't like it either. I wish it was different. But if it was different, it wouldn't be as cheap. So Chris has been looking at Kroger. So, hey, let's take a look at Kroger really quick. Let's see here. Kroger, KR. I used to own Kroger too. I guess I used to own a lot of stocks. 2.4% dividend yield, safe dividend. They've got a 5-year dividend growth. Wow, 16%. That's fantastic. The last one was 10%. Look at this chart, man. That dividend is growing like crazy. Let's take a look at their earnings payout ratio. That looks very good. Earnings per share seems to be trailing off a little bit, so I'm not really sure what's driving that. They've been buying back some shares, so that's fantastic, although the last few years they have not. Sales are flattening out. Return on invested capital is okay at 15%. Not terrible. Net debt to capital is about 57%. Their interest coverage is about 11.87. So that looks fine. Let's take a look really quick at what their fair value is. Their fair value is 55, trading at 52.77. That looks to be fine. And is there anything else I want to look at? No. I think so. For me, I think Kroger. Here we go. You ready? Kroger. Yay! It's a good stock. I think it's a good stock. Yeah, absolutely. So it's not something that I'm interested in. Again, it's a retailer, but from what I can see, it looks fine to me. So yeah, not worried about that at all. All right, let's see here. Let's see what's next. Next on the list is, all right, so Chris says, from my understanding, the machines ASML sells need to be replaced, upgraded on a fairly regular basis. Yeah, I think that's right, because technology is always increasing, or the need for technology is always increasing, because they're wanting these chips to be smaller and smaller and smaller. So it's not like they can use these machines for 20 years. I guess they can if they're, replacing parts, but like in cell phones, these cell phones, they don't last forever. So, I think that's right, but I don't know if that is what's driving this, or if there's something else to it. So Janice is buying up QQQM. That sounds good. Chris says he gave Broadcom and AMD for semis, and then at big position in SOXQ, and he can catch all the semi plays. Yeah, that sounds good. Number 2 is that SOXX or SOXQ. I have a few shares of XOXQ. I think his is SOXQ. I invest in SOXX. But again, they're all semiconductor ETFs. So let's see here. Yeah. Oh, Kenji's in the house. Yo, my friend. Good to see you. Welcome. Glad you're here. Let's see here. Yeah, here's Chris. SOXQ is basically a copy of SOXX, but half the expense ratio. Yeah, that may be something I need to look at. But sometimes when you're in it, it's just easier to keep it. Wow, yeah, that's a great question, El Dynamico. Pretty soon, 5 of his positions will overlap SCHD. Should I sell out of SCHD? I think it depends on what your position is. Why do you have SCHD? Do you have it because it is giving you diversification, or do you have it because it's giving you dividend income? And if it's because of diversification, and you're already overlapping significantly with it, I'm not sure it's really giving you the value that you have in it. If it's for something else, if it's for the dividend yield, then maybe it's worth hanging on to. But I think it really boils down to, why do you have it? Why is it a part of your portfolio? And if it's there because of diversification, doesn't sound like it's doing a lot of that. So it might be worth looking at moving on. Oh, yeah. Robin's down 23% on UPS. Bought it before they increased pay to employees. I thought about DCA down by buying a few shares. Will you please go over it? Yeah, I think, Robin, I think that's a good approach. I think, here, did I pull that up? I think I did. But UPS has, here, let's just look at some things here. And I will flip the screen here for you guys. But yeah, I think we looked at this. Yeah, I think we looked at it. So yeah, I think, Robin, I think it's worthwhile to average down on UPS. I am buying UPS. I'm really buying it more as an income play than as a growth play. I think the 5% yield or whatever it is attractive to my income portfolio. So that's why I'm doing that. I just started buying it about, I don't know, a few weeks ago, and it is currently about 1.4% of the portfolio. Let me make sure of that. Total. Oh, my internet's slowing down a little bit. But anyway, I think it's about 1.4% of the portfolio. So it's not a huge investment of mine, but I do plan to get it higher. So yeah, man, I've got the blue circles here. So anyway, I would DCA down, because I think that long term, I think the future is bright. I don't think you need shades for the future, but I don't even have any sunglasses with me, or I'd put them on. Let's see. UPS is I need to get a different view. Holdings. UPS, yeah, 1.4% of the portfolio. So yeah, I mean, I get it. And it's not fun to be down. I'm down on Lamb Weston, right? But I did average down on them pretty heavily when they were at 55. Now they're back around 62. So that helps a lot. But, it really depends on, what do you believe about UPS? Do you believe the management team can get that figured out? And I think they can. But if the thesis is different now, then, it might be worth getting out of it. But for me, I like the future. I think they're gonna figure it out in the medium to longer term, and so I think now's a good time to pick it up. That's the way I'm looking at it anyway. Yeah, Kevin says thanks, and yeah, you're welcome, man. Let's see, what do we have here? Oh, ex dividend dad. Welcome to the program, ex dividend dad. You forgot your intro, man. X to the who, X to the what, or that might be backwards. X dividend dad. Um, how big will the cut be? 0.75, 0.5, 0.25. He's talking about the discount rate for that the Fed has. And here's what I think. I think the cut will be a quarter of a point. And I heard somebody say this today, and I think it was Sarkarian on Morningstar, and it is that I don't think it'll be 0.75 at all. I don't think that would even be in the cards. So I think we're looking at either 0.25 or a 0.5. I think my opinion is it's going to be 0.25. I think if it's 0.5, then I think that's going to kind of rattle the markets. I think stocks will actually decrease if it is a bigger decrease. And that is because it will give the signal to the market that the Fed has gone too long with the high rates, and they're trying to get them down quickly because they're maybe seeing something that's going to give them not a soft landing in this economy. So I think we're going to see a quarter point in September, and I don't think we'll see 5, certainly not 0.75. So you heard it here, market down. Let's see what happens. Yeah, so Berkshire is buying Sirius XM because I have to say it that way or my phone asks me what I'm saying. She says, every super investor is buying Oxy. Yeah, not me. How much of the stock market is overvalued? No, that's a great question, Janice. I heard today that the stock market overall is overvalued. And again, a lot of what I look at in terms of valuation is from Morningstar. So according to Morningstar's valuations, the stock market overall is about 9% overvalued. So what does that mean? That means that, some of the stocks are really overvalued and some are undervalued. But so what we're trying to find are the ones that are at least fair value or even undervalued. I'm not opposed to paying a fair value for a stock if it's going to give me the return I want in the future. I'm not a 100% value investor. My Lamb Weston investment is a value investment, but Visa is not a value investment. It is, I believe that's a fair value for that stock, and I think it's going to provide a 16% gain every year, actually, moving forward, at least for a while. So, how much of the stock market is overvalued? I don't know how much of it is overvalued, but I can tell you that the stock market overall is overvalued by about 9%. Hopefully, that's helpful. Hostile takeover. Yeah, that could be. Yeah, the slow clap. There you go. I thought that was fun. Let's see what else. We are at hour and 8 minutes. Man, you guys, we've been having a good time. I didn't even know what time it was. Yeah, Russ. At least we agree on that, Russ. It is the bag of poop at the bottom of a dumpster that's on fire. Yeah, I agree. I agree with that. Oh, good. Kevin Mendoza likes the new sound effects, so we'll keep those going. So every week when we're talking about stocks, we will have the 3 sound effects going. Russ says that Dillard's does some special dividends, so that might be kind of fun as well. And yeah, ex-dividend dad says it's a hard pass on Dillard's. Let's see. Wow, you guys have a lot of stuff going on here. Let's take a look for Jared. Hey, buddy. Let's look at PNC. My son used to work there. One of my sons used to work there in Pittsburgh. Let's see. Stock analysis. Let's see. Wow, 18% up in the last 3 months, 24% in the last 6 months. Last year, it's up 57%. Man, it has been killing it. It's been knocking it out of the park. Let's see what the fair value is for PNC. There's a joke that I heard. It is really an awful joke. I'm not going to tell it, but it did cross my mind. So just thought I'd tell you that. It's really bad. So fair value is 175. It's trading for about 178. So it is, it's not a great, it's not a deal, but it is certainly trading at its current fair value. And just for grins, let's take a look at this. Ooh, 55. I think most banks are at 55, though. I know US Bank is as well. They got a 3.6% dividend yield. Let's see, what else do they have? They've got, 12%, but their last dividend growth was 3%. But, in this economy, that's not terrible either. Let's take a look at their payout ratios and stuff. Those are, they're moving upward. And what that means is that their dividend growth is growing faster than their earnings are growing. That's not a fun place to be. Yeah, you can see the earnings are actually declining a little bit. Let's see what else we got. Shares are coming down. ROIC is not appropriate for a bank. Debt to capital is 57%, and that doesn't work either. So, I tell you what, I don't know, man. I don't know why they've gone up so much. Their dividend has grown like crazy, though. Look at that. Well, I've got to make a decision, guys. What is it going to be? What is it going to be? I'm going to say, because it is at fair value, I'm going to give it the. If you want to go into PNC, I think that's fine. I don't think there's anything wrong with PNC. And now I do like US Bank better. And I like it better because its dividend yield is higher. And I think it is a very, very well-run bank. So, but, PNC, I think it's fine. If you want PNC, I don't see anything wrong with it. Let's see here. Man, we are already at an hour and 12 minutes. You guys are rocking it, man. Yeah. No, that's a great point, Chris. ASML, there are a ton of fabs being built, and ASML will fill just about all of them. I think that's probably the best argument that I've heard about, how the analysts are maybe seeing something that we're not able to see in the numbers. Yeah, that's a good point. That's definitely worth thinking about, is that they will be providing the equipment for Intel, because Intel's building those things out in Arizona. TSMC is building those fab plants in Arizona, and really all over the world, right? So, yeah, it might be worthwhile looking at. I think I'm going to look at those more closely tomorrow. So my schedule after today is freeing up a lot, and so I'm going to start looking at some of this stuff in more detail. Yeah, SOXX for options, SOXQ to hold. So maybe I'll look at switching over to SOXQ. We'll just have to see. Looks like Pat's leaving. Good to see you, my friend. I'm glad you enjoyed the live stream. And Yeah, so El Dynamico, this is about SCHD. He says, I think I do it for the diversification. However, as I start building up my positions, I'm noticing that my positions are similar to the ETF, but giving me more dividend income. Yeah, yeah. I think I think if you're looking at it for diversification and it's not really giving you the diversification, I wouldn't worry about holding a lot of SCHD. Now I use VOO as a tool to give me diversification, so it really doesn't matter what individual stocks I buy because 30% of my portfolio is in the S&P 500. And it's hard to buy 500 stocks, but it might be a little easier to overlap the SCHD ETF. So, yeah, thanks, Jim. Hit that like button. Um, Chris thinks it's 0.25 for the next 3 meetings, so that's good. Shannon is leaving us, and it looks like I'm about to leave as well. Oscar is leaving, and Chris says it's dinner time. So, guys, it was really great having you on the stream tonight. I had a great time, and I'm looking forward to next week. And you guys have a great week, and I will see you on the next one.